Hello, today is Monday, the 30th of March, 2009. This is Brian Shannon from Alpha Trends, and we had some profit taking here today as the NASDAQ, we know, had gotten up to the upper range of where it had been this year, and perhaps is pulling back, as I had mentioned last night, to create a right shoulder. Way too early to really take that seriously, but just something to keep in the back of the mind right now. We do have the market kind of trying to stabilize intraday there at a rising 10-day moving average, but much too early to say that there's any support here that can be trusted. We can see that this trend line has been broken on the 30-minute time frame. That also puts us with this gap below the 5-day moving average, and this weakness was enough to turn that 5-day moving average back lower. So we've got a declining 5-day moving average. That means that any rallies in here should not be trusted until we have further time to consolidate. So it looks like the sellers are back in control for now. If we take a look at since the big, we've been keeping an eye on the, since this move began right here, what's the average price been? Well, the average price that the NASDAQ 100 has traded at has been right around this level right here, $39.38. Now, that's not some magic line in the sand that if we break below there, that we're going to completely fall apart. But it is worth knowing that the psychology of that level means that basically the feeling as far as we're going to have more people looking at this rally as a failed rally, whereas while we remain above it and it's rising, more people are looking at this market a little bit more confidently. So a break below there would be a confidence breaker, but right now we have to keep our eye on the trend, which again on this 10-minute time frame, on the 30-minute time frames, we have lower highs, we have a lower low, we have a broken trend line, we have a declining 5-day moving average. So there's no reason to trust short-term strength in here right now. If we look at traditional support, we've got some, right here at about 29.60. If we take a look again at the Fibonacci off, this is what we looked at last night. The Fibonacci from the lows prior to that gap, just to the recent highs, 38.2% retracement would bring us down to 29 and a quarter. And on the daily time frame, hold on, let me get my trend tool back here. If we take a look actually at the daily time frame, 29 and a quarter, we can see right here that the 50-day moving average is at about $29.13. So let me put those Fibonacci levels on here again to show that this is a potential significant level right in here, about that average 50-day moving average level, because it's further takes on some significance because it's the level where we also will encounter a 38.2% retracement of this most recent strength. So for now, I think that that looks like a reasonable level for this market to come down, and even the 28.5 level looks like a reasonable level for this market to come down to, and then perhaps begin to stabilize, and then we can start looking at maybe we're going to be building this right shoulder and eventually breaking past this resistance. But again, I remind you, we are in a primary downtrend. If they don't scare you out, they'll typically wear you out. There's no reason to really get overly excited about the upside in here right now. Let's take a look at the financials. They were down 79 cents or 8.6%. They continue to provide tremendous volatility and opportunity for intraday trades. This has been the downtrend line that's pretty much held this market back since mid-December or so, and we're in this area where yesterday I was saying, we had these higher lows in here, and if somehow it could get above this resistance, then maybe it could squeeze the market higher once again. Obviously, that scenario fell completely apart on the open as we gapped lower, and basically the pressure remained on those financials all day long. If we take a look at the daily VWAP in here, you can see that after the gap lower, we had this market try to stabilize a little bit, but then it broke down through the daily VWAP. The daily VWAP was declining all afternoon, so there was no reason to trust these little rallies. It stayed trapped underneath this trend line as well. If you take the high off of the take these peaks, it stayed below that trend line, and just a very nice pattern of lower highs and lower lows in here. Someone asked me me, Brian, would you stay short the financials? Well, number one, I wasn't short the financials, but I don't know where this person was involved with the short financials. So, just make sure that you manage risk at all times. And right now, if we take a look at the average price that the financials have traded at since this market rally began on March 10th, we can see that a week ago, Friday, we'd seen the market find support and bounce very violently from that level. We'd seen the market unable to make a higher high in here in spite of these higher lows, and today we broke down and pierced through that average price since March 10th. So right now the financials look more vulnerable than any group, and if we take a look at the Fibonacci, and again, it's the psychology of that volume weighted average price since this move began, is that now the average participant who's long these financials, if they bought it from this gap higher, they are now in a losing position because the average price it's traded at since this rally began was about $8.50. It doesn't mean the market can't recover from here, but it does make it more likely that we're going to see a little bit deeper pullback. And obviously, when we look at these 10-minute time frames, the 30-minute time frames, whatever time frame you look at, there is just no evidence right now that the market has found support. These Fibonacci levels are potential levels, such as right now we're down to this 38.2% retracement level basically. If we take a look a little bit further back, we can see that we've got this this level in here just above $8 a share potential support. But if those levels break down, then we could be heading right back down for a test of the lows. So you have to continue to be very vigilant about risk management in this environment. We're getting some fantastic rallies within a primary downtrend, and when the market starts telling you that, now the average participant since this rally began is losing money on the if they're long, then it also says that the average participant on the short side is now making money. So that emboldens them and just changes the dynamics a little bit. So something to definitely keep an eye on. Semiconductors, they're right at the average price since the rally began. If we take a look in here, we had seen, and I was outlining a scenario that a lot of times we get a break past this little level of resistance, trap people in who say, there it is, that's the breakout that they've been waiting for to get long. But again, breakouts don't typically occur and sustain after a big move like this. It's healthier to see a pullback perhaps down towards 18, maybe 17 and a half or so. So the semiconductors, obviously, they broke their uptrend line here as well. We can see here on if we throw Fibonacci on, we can take basically these lows in here, that a 50% retracement would take us down to this prior peak from mid-February. 38% we're basically there. But right now we do have a pattern of lower highs and lower lows in the semiconductors, and we have a declining 5-day moving average. This is the first time in all these indices that this 5-day moving average has been declining since we first leapt back above it on March 10th, so you have to take it very seriously. Let's take a look at oil. Yesterday I had said that oil looks to be broken, that it looked like a failed move past a declining 50-day moving average, and the direction that these rallies that occur above a declining 50-day moving average typically fail, and they get a lot of amateur technicians excited because they think, hey, we're above the 50-day moving average. Now let's see if this market can stabilize near that 50-day moving average, and then perhaps it finds some support. But we have to wait for confirmation from the shorter term time frames. With a steeply declining 5-day moving average in here, it tells me that it's gonna be 2 to 3, 4 days before you can give any serious consideration to maybe getting long the USO or the DXO or whatever way it is that you like to trade the financials. The Russell 2000 also had a 2.8% pullback in here today. If we look at the 30-minute time frame, we can take a look at some couple trend lines that maybe best define this trend. I think that this is probably the most relevant right now. And obviously we broke down, we're below a declining 5-day moving average here on this 30-minute time frame. We can see the average price for the Russell 2000 since the move began is right around this $40.74. So below that, there's a psychological impact, I think, and it goes beyond psychological because it's real prices, and prices have memory. And how do people feel about the market, basically? Well, if the average participant is losing after this so-called the bottom is in, then it could add further downside. Here's a 38.2% retracement that comes at about $40.60. That's pretty close as well to this average price that we've seen. It looks as though we're in for a little bit further profit taking from this rally. I don't think you want to be a buyer. Same goes true, obviously, for the S&P 500, which was down 3.4% today. It lost $2 and what is that, 82 cents. So we see here that this market is back below also this $80 level. So that's kind of important, I think, that it had been a key psychological level as far as support back here, resistance for a little bit, recaptured it. Now we're back below. Maybe we're heading for these levels in here. No one can tell you where this market is going to pull back to, but I can tell you this right now: the path of least resistance in the intermediate term is lower for the first time since this rally began, because we have right now a declining 5-day moving average, and this moving average had been advancing. It had been showing us more frequent tests of a trend line. This is the one I was talking about yesterday. The more frequent test of this trend line made me believe that we were probably going to break down soon, but you didn't want to trade it until you saw evidence. Well, we saw that evidence today. The market broke down. Couldn't really get above that VWAP at all until very late in the day. But still, obviously, this market, this short-term trend or the intermediate-term trend of the last 2 weeks is now broken. Take it seriously. Wait for the dust to settle if you want to be a buyer, and otherwise, you ought to be looking for some scalping opportunities on the short and long side, I think.